helping you to weather good and bad economies without putting retirement on hold. This is the Tumolo Financial Podcast with Ken and Nick Tumolo. Ken and his son Nick know that creating a comprehensive financial plan can align your hard-earned life savings with your retirement goals. Consider them your retirement architects. Now, the Tumolo Financial Podcast with Ken and Nick Tumolo.
Roth conversions have been a hot topic in retirement planning over the last few years, but there is also some pros and cons that you need to know before deciding to do a Roth conversion and making sure it works for you. So first thing I'm going to bring up, we're going to go over pros first, and then I'll bring up the cons. Number one pro, tax-free growth and withdrawals. So Roth accounts, as long as you follow the guidelines and the rules, it's going to be fully tax-free. Gains, principal, everything's going to be tax-free. So one thing I always like to bring up is like conversions. A lot of people like to ask me, okay, do those Roth conversions work? That's one of the main things we like to do is tax planning. And you really do want to make sure it works for you and even legacy planning down the road. Because that Roth too, down the road, if you're looking at legacy planning, passing it on, it still goes tax-free to kids too. And the huge thing is non-spousal beneficiaries can keep that in there for 10 more years. And the Roth don't even have to take required minimum distributions. It just has to be emptied out by the 10th year. So there is some very good advantages to doing the Roth conversions, but you got to make sure it works for you.
Yeah, it's always if it works for you. Another big thing that you didn't mention was there's no required minimum distributions for participants. I mean, it's you get the money into that Roth account, and then basically you get out to age 73 or 75 and the IRS does not force you to take money out. My guess is the reason you're not forced to is because there's no taxes owed. You already paid your taxes. So there's no advantage for the IRS. It's just an advantage for the participants, the people that have these Roth accounts once they do it. So really what you're doing is trying to take control over things such as, one, whether or not your taxes are going to become a mess later on in life. So you get ahead of it with these conversions. So kind of the whole tax timing piece of it. And then retirement income strategy. We've built plans for people before in the past where we've done Roth conversions earlier. And then later on in their later years, we're drawing out a Roth and IRA money to control taxes. Or the other big piece of it, estate planning. Because the big thing is you don't want to leave more money to Uncle Sam. You're trying to leave more money to your beneficiaries. So if you get a head start on this estate planning and head start on the tax piece of it, these conversions can actually give you a big advantage.
Yeah, another pro is also potential long-term tax savings. So converting can make sense if you expect it to be in the same or higher tax bracket. I always look at those things because you think about the federal tax code's progressive. It goes from 0, 10, 12, 22, and so on. So you want to make sure these Roth conversions work for you within your tax bracket or going up to the next one if it makes sense. And the other thing too is you think about it, if you keep your money in a 401k versus a Roth and you have $100,000, or if you had your starting point at $100,000, I should say, and the money grows to $200,000, the Roth, you're getting the full $200,000. The IRA, depending on your tax code, you're not going to get that full $200,000. You're probably going to get it $180,000, maybe even less than that, because of taxes and wherever you fall in the tax code. So you really want to look at these things. What's the best plan for you? What's the best draw planning for you to go through it?
Yeah, Nick, I'm gonna pull us back to RMDs because I forgot one thing to mention in the when I last spoke is think of this: if you save a lot of money in those IRAs, those 401ks, and then you get out to 73 or 75, and a lot of the money is in those types of accounts, then you might have a big RMD, meaning you have to take out a lot of money at one time. You lose control of taxes, and then you have to pull money that you don't even need. It's just you're required to. There's no other way to put it, because if you don't do it, you pay taxes plus a penalty, so you pay even more. So it's a big mistake. So really what we want to do by doing these conversions is knock down a future problem, make that future problem smaller, or try to erase that future problem. So by doing these conversions, where you're basically taking control of your own taxes.
Yeah, and then one more pro that I'm going to bring up is estate planning benefits. And I know I did in the first segment, but Roth assets go tax-free to beneficiaries. And that's a huge thing. It helps avoid like the tax bomb for beneficiaries. So conversions might make sense for you. Just because they changed the rule back it was 2020, non-spousal beneficiaries had their full lifetime to pull all the money from. They made you take a minimum distribution, and each year it just slowly chipped away at it. Now it's a 10-year rule. So you're squeezed in. The government made a great rule for themselves. They're going to really pan out in 2029 when that 10-year rule starts for the first segment of people. So really doing those things, it's going to help you. It's going to help your beneficiaries. Like I said, that Roth, it could grow for another 10 years tax-free for a non-spousal beneficiary, spousal beneficiary. It could even spousal beneficiary can grow even further. So that Roth tax-free savings can help the family, because what happens is usually parents, when they pass away in their 70s, 80s, 90s, kids are using their 50s, 60s, making the most money at the time. And because of that, Uncle Sam becomes a bigger beneficiary of your money. So do these advantages work for you? So let's start talking about the cons now.
The cons, yeah, I know everything. We made it all sound rosy. Roth conversions for everyone. But yeah, there are things to be aware of, and it's not always right for everyone. So basically what could hurt you? What people are afraid of, immediate tax bill. And what I mean by that is when you go to do a conversion, you're taking money out of those traditional accounts, traditional IRA, 401k, 403b. You're paying taxes because it looks like income on your tax return. So that shock of paying extra taxes early, it could be a big number. But the thing is, really what you want to do is do the math. You want to see the numbers. You want to see if paying those taxes early actually gives you an advantage down the road, because that's really what it's about. We actually had someone come in and they, direction of their advisor, had him do a $500,000 conversion in 1 year. Should have been done over multiple years, but in 1 year, it really messed up the person. One, a bunch of the money was in the highest tax bracket, and two, it messed up their Medicare. So you got to be careful doing these things. But yeah, I just always want to say, start with the numbers.
Yeah. And another one I think about too is risk of being pushed into a higher tax bracket. This is what I talk about doing partial Roth conversions when I talk about it, because you're not going to move $1 million over in 1 year to do a conversion. It's going to push you in the highest tax bracket and also do a few extra things, which I'm going to talk about in a second. But it's also going to reduce eligibility for credits and deductions. You go over a few of the things that we've just recently had for laws. Social Security, there's a state and a federal law. If you go over a certain amount of money, you start getting taxed on Social Security. So you really have to look at these things, because when you do a conversion, for example, you do a $50,000 Roth conversion, that shows up on your tax bill, on your income bill for the year. So your income goes up at another $50,000, which could push you up in the next tax bracket, could make you pay tax on Social Security. I really like to look at, just to kind of go with the current tax code, looking where those big jumps are is the main thing. So 0, 10, 12. From 12 to 22 is a 10% jump. Then you got 22, 24, little jump. Then it jumps to 32. That's an 8% jump. So you really want to look at these things before you make the decision.
Yeah. And one other thing that pops up is the 5-year rule. One thing, if you're going to do these conversions, each year you do a conversion, that amount that you convert falls under its own 5-year holding period. So if you think you're going to need that money, you probably shouldn't be, well, I would say you probably shouldn't be doing a conversion to begin with at that point, just because you have to make up for the taxes and you have to hold the money in the Roth long enough to make up for the taxes that you paid. So if you're really thinking, 5 years, I might need the money, then don't do the conversion. That's my quick advice. So kind of the thing is, you don't want to limit your short-term flexibility.
Yeah. And another con too is impact on Medicare premiums and other costs. This actually makes me think about someone that I just saw recently, because what we're doing is we're playing in the 24% tax bracket. And if you didn't know, in the 24% tax bracket federally, there is 4 Medicare jumps right there. And they range from about $80 to about $120 per jump. So if you're doing conversions and you're saying, you know what, I'm going to go all the way through the 24% tax bracket to the conversion, you got to be careful those Medicare jumps too, because it's per person. So you're saying I'm going to do quick math, $100 each jump. That's $400 a month per person. And then you make it by 2, times it by 2. If you're a couple, that's $800 a month. That's a lot of money. That's almost $10,000 that's just going towards Medicare when you're making these Roth conversions. So like I say, and I'm going to be a broken record, make sure that advantage works for you, because I've had some people where I'm like, you know what? Let's not use the full 24% tax bracket. Let's only go up 1 or 2 jumps on the Medicare bracket so it doesn't hurt your portfolio.
Yeah. And the one thing, just going back to the last one again, when I was talking about the 5-year rule, it's not ideal to do these conversions if it's you have a short time horizon. Reason why I say that is you got to recover the taxes. So low return takes longer to make up the taxes. So if we have a bunch of bad years in the market, it's going to take longer to make up for it. High returns, meaning we're going through a good market, yeah, you'll make up the taxes a lot quicker. So kind of when you're doing that planning, I'm going to say you always want to assume a low rate of return for the recovery. This way, going into it, hey, it's going to take me 10 years, 15 years to make up for the taxes, but I'm going to be ahead. So bottom line, Roth conversion is powerful. But the thing is, it's not automatic. It may make sense if you're in a low income year, you expect higher taxes later, you have 10 plus years for growth, and you can pay taxes from cash outside the IRA. We didn't even touch on that, but that's okay. That's another thing to talk about. Be cautious. If you're already in a high tax bracket, it doesn't always work out when you're in a high tax bracket. You may need the money soon. And also, you can't easily recover from the tax bill. So instead of converting everything at once, consider converting gradually each year to fill your tax bracket. Visit with someone that actually puts the numbers in front of you so you know what you're getting into. And if you want help running a Roth conversion scenario on your savings, reach out to us. You can go right to our website, tfcheckup.com, or click the link below.
Investment advice offered through Tumolo Wealth Management, an SEC-registered investment advisor. Content contained herein should not be construed as an offer or solicitation for investment advice or for the purchase or sale of any security, insurance, or other investment product. Please consult with a qualified financial, tax, accounting, or legal professional before implementing any ideas or strategies discussed here.